Yes, it is Friday, the 13th of May today. I'm aware of it. Monaco 64 here, home of alternative economics and contrarian views. Today we're going to look at why, in my opinion, Jay Powell is no Paul Volcker. Yes, even Paul Volcker wasn't able to avoid a deep recession in the early 80s. Actually, there were two recessions. It was like what they call a double dip recession. I think there are a lot of people out there who think that the Fed and the Treasury, they can engineer some kind of miracle, that they can bring inflation down and not create an accident, a recession, or even worse. And I'm going to try to prove to you with data, not because I don't like Jay Powell or Janet Yellen, but I'm going to prove it, yes, with data comparing 1980 to now. And also look at Janet Yellen's track record. And I think she's a great contrarian indicator of what's going to happen. What about the markets? Yeah, we're going to look at the markets. Yes, sentiment in silver especially feels like it's at rock bottom. Gold as well, even though gold is actually up on the year. In most other currencies other than the dollar, in the dollar as of now, we're unchanged year to date. And everyone's saying, well, gold and silver are not a good place to be in times of inflation. Well, if you look at gold and silver in the 70s, they weren't going up all the time either. But back to the reasons why I don't think Jay Powell is, if you want to call it, a Captain Volcker. And Captain Volcker was able to keep the ship from sinking. And I don't think Captain Powell will be able to do so. So let's start with my main reasons why I don't think they're the same. Well, you can look at this data, go on their US debt clock and use the time machine. And this is the major reason why I think, people nowadays, especially in the mainstream media, mainstream economists, central bankers, they try to bury this data. They only look at the stock market, bond yields, GDP, and they try to convince the public that everything's fine. But back in 1980, public debt, US public debt to GDP was at 35.39%. So nowadays, the same statistic, debt to GDP, as of today is at almost 130%. It's 128.92. So it's debt to GDP. I would argue as well that GDP these days is overinflated. It's inflated, the number. And why? Well, because back in 1980, they used to calculate CPI or inflation correctly, or it was more realistic. It actually gave you an idea of what prices were doing, consumer prices are doing. Nowadays, yes, we are at 8.3% in CPI. But if you look at John Williams of Shadow Stats, if you calculate CPI, how they used to do it in 1980, it's more like 16 or even more, 16% or even more. And GDP takes into account the inflation. So if you're discounting only half of what inflation really is in the GDP is going to look a lot bigger. So I would say that this debt to GDP nowadays is probably more like 170% debt to GDP, this ratio. So That's the biggest reason why. And alongside the public debt, we've also got the total debt. Back in 1980, the total debt was 4.4 trillion. That's not just the public, but private and corporate debt. Yes, it was almost 5 times GDP. And right now, total debt is around 90 trillion, which is less than 5 times GDP. But we need to look at unfunded liabilities. It's the big elephant in the china shop, or gorilla in the china shop, whatever big animal you want to think about. Right now, it's unfunded liabilities are 169.34 trillion. And yes, it was a lot smaller back in 1980, and you didn't have millions and millions of baby boomers retiring either back in 1980. So that's the biggest reasons, all the debt and the leverage in the system. The second biggest reasons to do more with the financial markets. And back in 1980, yes, there were derivatives, but they were mostly of the commodity type, agricultural, metals. Yes, there were some financial derivatives, but they were very limited. They were mostly foreign exchange derivatives. All the interest rate derivatives that we see today, be it the T-note future, be it the OTC derivatives as well. Not we didn't have over-the-counter derivatives in interest rates like we do today. So there wasn't, the financial system wasn't leveraged like it is today. And you need to understand that all these derivatives are kept off balance sheet, and it's very difficult to know exactly how much there is. It was only in the mid to late 80s that actually the OTC derivatives started to take shape. And it wasn't until the late 90s when President Clinton repealed Glass-Steagall that the big commercial banks were able to get involved in derivatives. So there's two kinds of derivatives. There's the exchange traded, which we get public data for, so we know how leveraged that is. But the OTC, or over-the-counter derivative, no one really knows. It's just huge bets amongst financial institutions, hedge funds. Watch The Big Short and you will see. So yeah, back in 1980, that wasn't a thing, derivatives. It wasn't a huge thing. The big problem in 1980 were all the loans, I would say, to the Latin American countries. That caused a big problem. I think one of the big banks, Chicago banks, went bust because of that. And a lot of banks were in trouble because of the loans to Latin America, but they weren't leveraged. There weren't derivatives on it. I have a derivatives file, and it's one of the playlists if you want to learn a little more about derivatives. I worked in derivatives for 20 years, the exchange traded kind, futures and options. And back in 2008, it was derivatives that triggered the whole financial crisis. Bear Stearns, Lehman, all the investment banks, and even the commercial banks were up to here in leverage derivatives. They took the side of a lot of bets from hedge funds, even mutual funds. Everyone was involved in derivatives. And yes, it was reported at the time by the BIS, Bank for International Settlements, that the total notional amount of derivatives, and that's the size of the bet, doesn't necessarily mean that's how much you have to put down, because it's highly leveraged. You only have to put a tiny margin of the whole notional amount. But yeah, it was supposedly over $1,000 trillion, which is called a quadrillion. It's very difficult to fathom what that is. And after the '08 crisis, the BIS decided to change the accounting of that calculation to make it look smaller. So now we're told that it's about 600 trillion worldwide, these derivatives, which is probably about 10 times world GDP. But some people argue if you account it like they used to prior to the '08 crisis, it's more than almost like 2 quadrillion, which doesn't really matter actually if it's 1 quadrillion or 2 quadrillion because it's so huge. So why is that important to what Captain Powell is trying to do? Well, because interest rate derivatives, especially over the counter, which no one knows really what's going on because it's not regulated, is the biggest part of this 1 quadrillion plus. And if you change interest rates too quickly, you're going to cause havoc in the derivatives market. And the derivatives market is what keeps all financial markets going because it's mostly interest rates. And the notional amount, most people, the bankers used to say prior to the Lehman collapse, the notional didn't matter because counterparties just netted off the debit and credit that came on their margin accounts, and then it didn't matter the notional, but it did once Lehman went bust. They're on the hook for the huge notional amount. And yes, you just need one counterparty, big hedge fund or a bank, to go under and renege on a huge notional derivative position, and you could cause a daisy chain of collapse, of bankruptcies. And that's what happened in '08. And you didn't have that in 1980. So that's why I don't think they're going to be able to do what Paul Volcker did. And what does that mean? That means that they're going to have to keep inflating the system. And eventually you're going to end up with a worthless currency. And the dollar looks strong right now. But my analogy would be that we have the fleet of fiat currencies, all the fiat currency ships out there. And we're already seeing a lot of them sink. We're seeing the Sri Lanka ship of state sinking, the currency there. We've seen currencies we've seen the Turkish ship sink. We're seeing the Lebanese ship. We're seeing the Japanese yen sink. We're seeing the pound sink. And the dollar is the biggest ship. It takes a little longer for it to sink. So it looks like it's really strong, but eventually that will sink too in terms of value. And that's why I'm not getting rid of my physical gold and silver, not because gold and silver do anything special, but it's because they're just there and they're real and they're outside the system. What about Janet Yellen? Because I think she's a great reverse indicator. A little bit like Bernanke, who said that, I think it was in late '07, that the subprime mortgage crisis was contained. They didn't expect a recession. But we'll stick to Yellen right now. So this is what she said yesterday, May 12th, 2022, at 11:36 a.m. Got even the time. Yellen told the U.S. House of Representatives Financial Services Committee hearing on Thursday that, and I quote, "All of those things suggest that the Fed has a path to bring down inflation without causing a recession. And I know it will be their objective to try to accomplish that." So there you go. Yellen thinks it will be their objective. I think it's their wishful thinking, more like it. So why do I think this is a reverse indicator? Well, we have to go back in time because this is fresh, a fresh opinion. So let's go back to June 15th, 2017. At the time, Yellen was, I think, just leaving as Fed chairman. or chairwoman, or chair, if you want to call it that. And this is what she said then. During her post-meeting news conference, yes, she was still the chair, Yellen specifically referred to the balance sheet program. That's the QE, right? And they're trying to they were unwinding the balance sheet, or they're planning to unwind it. She said it was as watching paint dry, attributing the quote to Philadelphia President Patrick Harker. And then she said, this will just be something that quietly runs in the background. That's my expectation and our intention, Yellen said. Well, that was proven to be completely wrong because in 2019 and 2020, they had to reverse their QT, and the balance sheet went from 4 trillion to the recent level just a few months ago of 9 trillion. So completely wrong. And it wasn't like watching paint dry. There's a huge repo crisis in September 2019, and we all know what happened in March 2020. Yeah, some people will attribute that to COVID. I attribute that to the repo crisis. Well, there's another Yellen gem, and this was when? Well, June 27th, 2017. And I got this from usnews.com. It says, Yellen, I don't see a financial crisis occurring in our lifetimes. June 27, 2017. So what happened in 2020? Well, a financial crisis in our lifetimes. So yes, unfortunately, Janet Yellen is a reverse indicator, a little bit like Jim Cramer, I would say. So with that, let's look at where the markets are this morning. It's 8:25 a.m. London time. So we've got spot gold at 18.25. That's up just over $3. The low actually has been 18.0950 overnight, and the high's been 18.29. Silver is up 13 cents, or 0.2%. High's been 20.90, and the low 20.63. And yes, there probably is a lot of manipulation. A lot of the move in silver and gold prices is to do with derivatives. There are huge derivative positions, paper positions in gold and silver. I think all this will do is create an even bigger shortage of the real metal, much like what happened in nickel and is happening in other commodities. It's just a matter of time, I think. To the stock market, the Dow future is up 177 points, or 0.5%, 31,915. NASDAQ is up 160 points, or 1.3%. S&P is up 0.7% at 3962. FTSE is up 50 points, 7290. And the Euro Stoxx 50 is up 28 at 3635. So now let's look at the Forex, the currencies. Sterling is unchanged, 122.08. The euro got hit hard yesterday. It's up slightly, but still below 104. The dollar is up slightly versus the yen at 128.55. The dollar is actually down over 1% versus the yen yesterday. The dollar is actually trading at par with the Swiss franc. It is down 0.2%, but yeah, relatively strong versus the Swiss franc. Up until recently, we were in a range around 92. The dollar is down 0.25% versus the Chinese yuan at 680.85. Aussie dollar. Aussie dollar is up 0.5% at 68.90. And the dollar is down 0.25% versus the Canadian dollar at 130.10. The Kiwi dollar is up a quarter at 62.46. And we're going to quickly look at the Russian ruble as well today. And I'll probably cover it every day now. Someone asked me, why don't you cover the ruble? Well, the ruble right now, or the dollar, is trading at, well, the bid is 64.54 and the offer is 65.87. So it's, let's say, trading around 65. Yes, the dollar was as high as 140 at the height of the invasion, like when everything kicked off. I think the low for the dollar recently is 60, so the ruble is still very strong. So let's look at the general commodities. We got WTI crude up almost 1% at 105.69. We've got Brent crude up 1% at 108. High-grade copper up 0.75% at 413. And U.S. nat gas up 1.25% at 786. The TTF nat gas, the Dutch or European nat gas, was up about 10% yesterday. I don't think the energy crisis is gonna let up. I also read that OPEC is saying that it's very difficult for them to keep up with demand because a lot of other oil producers and other countries are not investing in the infrastructure. And it looks also like U.S. Congress is trying to punish OPEC, and they've warned OPEC guys that it's only going to make things worse. And if they do that, oil could go up 300% according to them. So, and I see that Finland and Sweden are going to join NATO. That's going to make the relationship between the West and Russia even worse. So it doesn't look good on the energy side. And by that, I mean, it's going to be more and more expensive to fuel the Western economy. And I would say the West has a lot to answer for. We're shooting ourselves in the foot, I would say. So let's finish off with the bond market. Yeah, yields yesterday dropped quite sharply. The 10-year, I think, dropped to 280. Right now, we're up 8 basis points at 290, right on the highs. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great Friday the 13th and a great weekend. Take care. Bye.